So let's get started discussing the economics calendar, what it is and how to use it. Now, the economics calendar is a fundamental analysis tool for traders to position themselves to take advantage of future currency movements or any other asset. The economics calendar is published daily and is the main trading tool for traders that use fundamental analysis as signals for entering and exiting trades, or just want to be aware of where you might get a blip in volatility no matter how you're entering and exiting a trade. Because whether you're going to trade from economic events and from news, or you're going to be a technician, by not paying attention to economic events, you could have made the most beautiful decision, the most perfect decision, entered the trade just right, but simply not knowing that there's an economic event that's going to due to come out an hour later. And that economic event could be exactly what market is expecting. It could be an unimportant event, but it could cause a momentary blip in volatility. And because you didn't know that that event was scheduled, because you didn't look at the economics calendar, that volatility stops you out and you get stopped out of a trade that an hour later would have made you a ton of profit. But by not looking at this simple tool to see if there's something that can put volatility in the markets, can ruin your trade. Now, the thing is, the direction of a currency pair can be changed in seconds. Fundamentals that are true in one instance can be rendered absolutely meaningless by fresh fundamentals a few seconds later. The economics calendar allows traders to keep track of economic indicators and political events that impact asset movement. Now, before we're going to go in and learn about the events, we're going to learn how to read the calendar. So let me take you over to a live calendar. And tonight we're going to be using the live calendars on investing.com and on FX Street. Now, let's talk about calendars in general. Today, you get the data just as fast as all the big hedge funds, as fast as the central banks, because it comes directly out by data feeds. Now, there are some events that are put together by private data collection services. There's like Thomson Reuters, and there's HSBC. Now, nobody's trying to pull the wool over your eyes. Nobody's trying to take advantage of anybody. But some of the events that are compiled by these private agencies, they are released to their subscribers sometimes up to 30 seconds before they're released to the public. So that 30 seconds isn't a big deal. But sometimes there's a hedge fund that's paying thousands and thousands of dollars a month, not to get more advantage or take advantage of you, but because they're subscribers like anything. You're paying for something as opposed to getting a free service. Okay, but you should be aware of it. But for us as CFD traders, it doesn't make a difference because nobody should be responding that fast to an economic event. Okay. Now, all the data that comes from these feeds. Okay. And it's being fed in by whether it's a government agency, by the releasing agency, whether it's Thomson Reuters or Marquette or HSBC, they're releasing it, and the same numbers are released to all the calendars. So whether you're looking at the calendar on ETX, whether you're looking at the calendar on investing.com, whether you're looking at the calendar on FX Street, they're virtually all the same. There's a few slight differences. Now, a lot of people will look at the calendar and say, there's a big difference between this calendar and this calendar. Well, actually, there isn't. There is creative and development differences. because there's, when you're getting a piece of data or data feed sent to you, it's all got to accept that data and put it into the calendar. But whether you put it into the left-hand side or the right-hand side, whether you're using reds, blues, or yellows, or you're using oranges or pinks, or whether you're using, like here we see colors for the significance of the event, and here we're using bullheads. Okay. Doesn't make a difference because on FX Street, the developer told it when you get a level 1 event, put it in yellow. In investing.com, the developer wrote in their programming, when you get a level 1 event, put 1 bullhead. There's other ones that use asterisks and other ones that use exclamation marks and other ones that use stars. But the fact is, it's 1, 2, and 3, and you just tell your computer, when it gets a 1, do this with it. When it gets a 2, do that with it. When it gets a 3, do that with it. Also, you notice the order of the columns. Okay. On FX Street, we have what they call the volatility over to the right. On investing.com, we have it over to the left. Again, it's coming through these data feeds, and the developer for this particular site is telling it where to insert that data on its calendar. Okay. But just so you know, now, the biggest difference between the calendars comes in what we call the forecast and also the information. So on investing.com, say, for instance, the first thing we're looking at is the tertiary industry activity level index. Okay. If you want to learn more about that, you click on the box, click on the hyperlink, and it's going to open up and give you all the information on the investing.com site. So it tells you an explanation of what it is, its importance level. It gives you the releasing source. It gives you the past data, and it gives you some odd and end charts. Okay. In this case, we're looking at a bar chart that shows we can see the last 5 years. We can see the last 1 year of data compared to each month. This page is handled by the site. And different sites. Now, one of the reasons I prefer FX Street is if you open up and click on their box, let's go to the same Japanese tertiary data. I don't have the calendar set up the same, so let's see. Okay, let's get them set up the same, and then we're going to, let's go to tomorrow. Okay, so here we have tomorrow. We're going to use, for tonight's class, we're going to use the durable goods report that's coming out tomorrow out of the U.S. anyway. So if we go to core durable goods report here and click on the box, it's going to give us this much information on investing.com. If we go over to FX Street and go to the durable goods order for tomorrow, okay, and click on their box, they're going to give us the basic same information, their own version of the information. For some reason, my computer's just big. There we go. Seem to be having a data feed. Okay. Whereas when you open the box for FX Street, they have a lot more developed charts and information. So if you want to see the actual and the deviation, or you want to see the true range or the vol, and then you can set it up to a particular asset and see how it affected the trading range during those report releases, And so FX Street has a much more involved information on each shit. So, and every one is slightly different. So you can decide which one fits you. The explanation will be the same. The data is the same. It's just what FX Street has developed to provide you in research as opposed to what each of the different sites. So, but you should be aware of this. So that's enough talking about that stuff. Okay, let's talk about how to read this calendar. First thing you should do with the calendar is always set it up to your home time. Okay. I use GMT time. You know, in the UK, you're still in BST time. And because you don't want to mistake the time of the data release. The next column is going to give you the currency and the country releasing it. Okay. Most of the time, yen and Japan are the same thing. It's really because of the Eurozone that we have started doing this, because you want to see the Eurozone to see if it's German data, Eurozone, because it's affecting the Euro, but it's also what country is releasing it. Then we have here the impact level, or over here they call it the volatility level. Okay. And this is one of the columns we talked about being moved around. Okay. Now, volatility, impact, importance, again, are all the words that are left up to the developer for the site to decide to use. Because almost all economics data is broken into level 1, 2, and 3. There is data like a central bank speech or the Brexit vote, which doesn't, now the Brexit vote tonight is very, very important. So it's a high level of data, but it doesn't have a rating, so to speak, because it's a one-time event. But we can see it's on the calendar. And it's a very important event. Okay. But sometimes there's lots of them that have nothing on them because they're just a speech by a central banker or the G7 summit. Okay. These have no rating, period, yet. So you have no rating, then you have level 1, 2, and 3. Now, these levels are very, very important because these volatility or importance or impact levels tell you about how much the markets will react to that event. So when you get level 1 events, and if you're looking at the chart that I have in front of you, I've already filtered out level 1 because if you leave in all the level 1 events and all the events that are tracked, the calendar gets too long for you to deal with. And level 1 events have no actual effect on any of the assets that we trade in CFDs, except possibly a stock. But really, they have no assets because they don't cause enough volatility. They're not important enough to the marketplace. And as you can see, it makes the calendar too long to even start dealing with. I've also filtered out all the countries that have their economics data would have no event on no information or they don't interrelate to any asset available on the site. Okay. So like Slovenia, Slovakia, Brazil, if you were trading the real out of Brazil, then it's important to you, but you can't trade it on the ETX site. Okay. Then you also have all the Eurozone countries. Most of the Eurozone countries, their data release has no effect on the euro at all. So the only countries that really have any effect on the euro will be Germany, and then sometimes Spain, France, or Italy. But it's really the German data, and there's, of course, then the overall Eurozone data. But we don't need to see all of those countries and all the little, because we couldn't make heads or tails out of them. So we filter them out. And then we get a calendar. Oh, let me turn up the and we can turn off the lower level events. And in this case, I turn off bonds because we're not trading bonds. But if you happen to trade bonds, then leave them on. So now what we've done is we filtered this down to something that we can actually deal with on a day-to-day basis. Now, the thing about the economics calendar is all the data is programmed way in advance. So if you want to see when the U.S. jobs report is for, April, May, June, and July, you can look in your calendar and see exactly what dates are due to come out. You can see, but really the calendar doesn't come into play until about a week before the event. So we have the time of the event, the currency, the importance level. We have the name of the event. Now, all of these events have odd names. And almost all the countries around the world release the same data, but it's called something different. Like in the U.S., the jobs report is called the non-farm payroll. Now, unless you were following the markets, even if you're from the U.S., you would have no idea what the non-farm payroll report was. But if you follow finance, then you'd know. But that's the same report that is called the claimant count in the UK. That's just called the jobs report in Australia. But after a while, you'll know what all of these are. Because every 30 days, they're basically virtually all released over and over again. But in the beginning, like I said, you can click on the line and see what it is. So like I said, we're going to be looking for just class tonight at a very important event, a level 3 event that happens tomorrow. Okay. And this is called Durable Goods Report. Now, the Durable Goods Report is made up of many reports. And as you can see here, we have a level 3. This is called the headline report. This is the number that comes out of that report that is ultimately important. Now, these reports are hundreds of pages long. And most of it has, first of all, they're not developed for the financial markets, and most of them have nothing to do with us in finance. On the core durable goods report, it's going to tell us how many washing machines were manufactured, how many cars were sold. It's going to tell us how many airplanes were sold. It's going to tell us how many, T-shirts were sold. It's going to tell us what retail sales were. It's going to tell us about anything. Durable goods. If you click on the button to open, durable goods are things that last more than a year. So like clothing isn't durable goods. Groceries aren't durable goods. Those fall into retail sales. But core durable goods is very, very important event. Okay. Now, why it's important, you can do a little research, but we know we have the 3 bullheads or the red on the other calendar. So now we know that this report is due out at 12:30 our time, or GMT time. It's going to affect the U.S. dollar. And durable goods will most likely also have some slight effect on the U.S. stock market. And we have the name of the event. Now we have to go all over to what these numbers mean. And this is where it gets important. We come over here and it's called previous, forecast, and actual. Now again, if we go over to the FX Street calendar, it's actually called previous, consensus, and actual. And the consensus or the forecast number is one of the most important numbers. Now, this previous number is written in stone. Let's take that back. It's not really written in stone. This previous number is released, or it's just whatever the report was last month or the last time this report was released is what that number was. Now, because these reports are released so often and so quickly after the month is over, And they're huge statistical reports that sometimes the reports have to be adjusted. And this happens through what we call a revision. And these revisions are sometimes released prior to the report or will be released at the time of the report. So we can see here our durable goods report has been revised from 1.8 up to 1.9. That's only for last month's release. That's all it's telling us is last month's report was revised upward or downward. Okay. And that's a good or a bad thing because it all comes into play on how overall the economy is, and it also has an effect on the current report that's about to come out. Okay. Now, all of these numbers will be exactly the same from one site to the next. The number that becomes a little bit flexible is what we call the consensus or the forecast. The consensus or the forecast isn't released. No data reporting agency, no government agency releases any report or any piece of information saying, oh, we can expect this report to come out at this number. Okay. Doesn't happen that way. These consensus or forecasts come from financial agencies. Oh, well, we just see the news pop up. They voted down Brexit, or the Brexit deal from May. Very bad, the defeat. So maybe there's not going to be a Brexit. I have no idea. It's going to be the pound, the FTSE should be insane for the next couple of days. But these numbers come. A lot of times you'll be reading Bloomberg or Reuters, and you'll be seeing Bloomberg's consensus of 95, analysts or 95, purchasing agents we surveyed say this. So we estimate our forecast at this number or that number. So depending on where the individual site is getting their forecast, because it's not part of the data feed, okay, we might see some variation. So we can see for tomorrow's report, we're expecting a 0.1% increase in capital goods orders or core capital good orders. Okay. And if we go over to the one from investing.com, okay, we see the same 1%. Okay. Now, if we notice on investing.com, they haven't posted the revision upward. So they're still at the 0.1%. Because in most cases, the revisions are posted when the data is actually released. Now, because this is a very important report, this report will start creating some volatility in the markets as it gets close. Now, what the reports don't really tell you anything about the current economic situation. They're not based on the value of the asset. They're not based on, they're not a direct reflection on the current state of the economy. Okay. They're simply a mathematical calculation on what is happening. Okay. In other words, the jobs report isn't a bad report or a good report because the economy's bad. So 2 years ago or 3 years ago, when we were still in the middle of the financial crisis and unemployment was very high, okay, that is a reflection of the situation. But if the unemployment dropped, 0.1%, that doesn't necessarily mean the economy got better. If the U.S. added 150,000 jobs, doesn't mean that the economy got better, and that's why they added the jobs. Okay. So, and a good report or a bad report doesn't get better or worse because of the economy, because the reports have no analysis to them. They're strictly true reporting. So if we go look at the history of the core durable goods report, let's go open the box here. Investing.com's having trouble with their feed. But if we go down here and look at the actual, there we go. So let's go back and look over the last 2 years in a bar chart. And we can see in a line chart, we can see this has been all over the place, up and down, up and down, up and down, having nothing to do with just exactly how good the economy's doing. Because basically the economy's been doing extremely well in the U.S. for the last almost 2 years. But we can see the report has gone up or down because the report is adjusted, released each month. Now, if we looked at an average on a quarterly basis, we might see something different. But for us, for trading, we're only concerned with what that report is. So when it comes back to the markets, look at the previous, and that's known information. They're then going to look at the forecast. When the forecast is released, the markets will adjust to the forecast. So let me tell you a little story here. No, let me get my, come on. I'm going to tell you the story about your kids and their report cards. Because if you stop to think that an economic event is like a report card on the current economy, or the current situation. So today, you're sitting down to Sunday dinner with your kid. And you say to your son, well, kiddo, report cards are due on Wednesday. How do you think you did? Well, your kid's a pretty good kid. He's pretty honest. He's pretty straightforward. And, you rely and depend on him. He says, well, Mom and Dad, last semester, I brought you home all C's. And they say, yeah, we remember. He says, well, I think I did a little bit better this semester, and I think I'm going to bring you home all C pluses. Now, you're good parents. Now, that's an improvement, but you're still going to give them the lecture about studying a little harder, less time on Facebook, less playing soccer, and more time studying to get in. He wants to get to university. But you didn't go back to school and do any analysis. You didn't talk to the principal and find out how many kids did this good and how many kids did that good. And you didn't find out they had a new bell curve in the school or they're using a different grading system. Just like the economic calendar doesn't do any analysis. It gives you information for you to do the analysis from. So now you have the previous, which was all C's. You have your kid's forecast for all C pluses. Now, you're pretty happy parents. At least he's improving. He's not failing any subject. A C plus puts him above average in all of his subjects. So you're happy parents. But now you set your expectations to all C pluses when he brings home that report card Wednesday. So what's happened is you've set your expectations based on the forecast. Same thing happens in the financial markets based on the forecast of the report. The prices of the assets adjust to the market expectations, to what they expect that report to be. Now, on Wednesday, the kid comes in from school, hands you the report card while he's running out the back door to go play soccer. You open up the envelope, and it's all B's. You're shocked. You're thrilled to death. Why? It was better than your expectation. Not we haven't talked about that. It was better than the previous report card. It's better than what you expected. And this is what causes the market volatility. Okay, same thing if he brought you in all C's and 2 C pluses, you would be disappointed because it was less than your expectation. Even though it was better than the previous report card, it was still less than the expectation that he had set with you. So again, this is how the market reacts. Now, you holler out the back door, say, hey, kiddo, you did really good. You know what? We're going to take you over to the mall. We'll stop and grab dinner at McDonald's and go to the sporting goods store and buy that new soccer ball you were looking at. Okay. So everybody's happy. Better than expectations. He's getting the extra benefits. The currency's going up. The stocks are going up. Gold's going up. Whatever it is that's affected by that event. And within seconds, you haven't even taken dinner off the range yet. The soccer ball comes in the back window, busts the window, and is sitting in your living room. Now you're mad. You holler out the back door, kid, get your butt in here and clean up the glass. I've told you a zillion times not to play on that side of the house. And forget the mall, forget McDonald's, forget your soccer ball. We now got to call the handyman. I'm going to, put dinner back on the oven, and there goes everything. And that's exactly what happens in the markets. 1 second, that positive event can be overshadowed by some news headline, something Donald Trump says, some craziness in the Middle East, or another event that's scheduled on the calendar right after that. A lot of times, you'll see an event that happens in the Eurozone, like a speech from Mario Draghi that sends the euro climbing, and it climbs against its cross currencies. But at the same time, an hour later, some economic data is released in the U.S. that's super positive, and what happens is you see the dollar climb. So the euro ends up going down against the dollar. Right now, I'm sure you're seeing the euro pound skyrocket, except it's not that the euro is going up, it's the pound is coming down. So in order to use these events, we have to learn how to decipher what is market neutral, market negative, and market positive. Market neutral is the range around the expectation or the forecast for this event that will have virtually no market volatility. Because there's a range. Like I said, if the kid would have brought you home 7 C pluses and 1 C, you would have had no response. Okay? Especially if the C was in a minor class. If we would have brought you home all C pluses and a B, you would have had very little response because you were already happy. Your expectations were already good. So there was a range that we would consider market neutral. Wouldn't give you any availability to trade, but it also wouldn't cause any market volatility. So therefore, if you were trading based on other, technical information, you'd be all right. Okay. And there's also this range that doesn't offer you any trading opportunities. Then there's a level past that we could say is market negative. That means that event missed forecast by enough that it's going to cause volatility and send that asset down. And then, of course, there's a range of market positive that will also create volatility and at the same time give that asset momentum to climb. And you do this by building the ranges around the price or around the expectation. Now, the forecast and the expectations come out about a week ahead of time. So therefore, you can start doing your research. It's one of the few times in the financial market you can actually do your research way ahead of time. Because once the forecasts are released, and like I said, they're released about a week before the event, you can start researching. You can start seeing a lot of things and learning what to expect. So let's go back to the economics calendar. Now, we can see, actually, I've screenshot this. Let me just get, instead of here, let me get on a screenshot. It's easier for me to draw my circles and everything for you on a screenshot. Okay, so here we have tomorrow's events. We have the durable goods report, which is the level 3 report, the significant part or the significant data of this overall huge report. Okay. We're expecting a 1%, a 0.1%, 0.1% increase. Okay. We're also included in that report are also the durable goods less transportation, the durable goods less defense, and the durable goods orders in general. Okay. Now, why this happens is the total durable goods report, less defense and aircraft, is the most important one. Okay, because defense spending isn't necessarily an economic event, and when the defense spends, it's big numbers. Same thing when you're including aircrafts, because aircrafts are millions and millions and millions of dollars. So 1 or 2 or 3 aircraft sold or delivered that month can affect this number significantly. So the important number is what we call core durable goods, which takes out these huge items from that report. Because just because Boeing signed a big deal with India to sell 47, F-15 fighters for $1 billion, it's not going to be delivered for many years, and it's really not part of the overall economy. So the core durable goods report is the report that's the most important, or the most significant number to the financial markets. Now, this comes out in little tiny increments. And that's the problem when we have reports that are in little tiny increments. Because to build our neutral, market negative, and market positive zone is a little bit difficult because we're dealing in very, very small numbers. But unless you wouldn't know that unless you actually clicked on that report section and opened up the actual history of the reports. So when we have something that's in 0.1% and let's take a look at we can see it only moves in 0.1%. And it stays in a very, very small range. Yes, we've had very bad ones. So you can see back in December of 18, the actual was minus 0.03% when the forecast was 0.03%. That's a very bad report, isn't it? So we would have expected a great deal of market volatility. But on the other hand, we had a big revision upwards. So what happens when you get a revision upwards, and it was revised up from 0.2% to 0.4%, that means that the expectation for this month might be out of sorts, because when they recalculated everything, and they, sometimes you have a 4-month weekend, a 5-month weekend, the first of the month falls on a Wednesday. So what happens is, ultimately, a lot of this data got pushed back into the previous month, and that's why that previous month jumped up. But because the previous month was so low, we were expecting a big jump in this month. Okay, so when we had a 0.3 and we got a minus 0.3, but we got a positive previous revision, we have to stop and think, okay, was this a bad miss or a good, a market neutral? And what happens is, you could only look at the headline event, the big event. So on the surface, you would have calculated this as being a market negative event. Not a market negative event. First, you're going to look at the actual and the forecast. So this would tell you it was a market negative event. Okay. And you can see how bad this was. But then we had a positive upward revision. So we call these bumps. Okay. So it bumped this very negative report maybe into what we might call the bottom of that market neutral zone. So then we would have to look at other pieces of this report. Which would be the whole overall durable goods report, as well as the durable goods less transportation and the durable goods less defense, and see if those were maybe better or worse than expected. So we can see in here this was revised from 1.8 to 1.9. So again, we get it bumped up. So you have to see, but you can do your research ahead of time. You could have looked at all of the months, the previous month, looked at where it came in, looked to see, okay, because a lot of times you'll see terrible months and good months, especially when you have holidays. Oh, they can come out absolutely terrible because the central banks and the federal government and the overall economists aren't looking at 1 month. It's only the financial markets. Because I can tell you 2 years ago, we had in December in the U.S. jobs report, we were expecting 130,000 jobs, and I'm just doing this off the top of my head here, but the example is fairly accurate. We were expecting 130,000, we got 130,000. But then January came around, and we were expecting 150, and we had 99,000. Okay, that said things were really bad. But then in February, we were expecting 150,000 again, and we got 225,000. And we had an upward revision to the prior months of 40,000. Now, why do things like this happen? Like I said, statistics and all this data is coming in from businesses, from governments, from agencies, from all over the place. Now, what do you think happens over the Christmas holiday when half the people that are reporting this data are on holiday? So, the purchasing manager for a big corporation is on holiday. So he doesn't submit it to the government until he comes back from holiday on the 3rd. Or a lot of companies were closed for a week. Or, a big holiday falls in the middle of a week. So companies hire people, but they told them, you know what, the holiday is on Wednesday, so don't start working till Monday. Or it's a Monday holiday, like Memorial Weekend in the U.S. And so they say, you know what, we're going to be closed for the Thursday, Friday, Saturday, Sunday, Monday. Start the following Monday. So they hired the same amount of people, but those people didn't start to that following Monday. So the gap could have been off if it fell over a month. So you have to take all of this into account. But it's understanding and knowing this that will help you trade in the markets. Because like I said, no matter how you're trading, if you're not even looking at economic events, and a lot of people don't trade economic events, but if you had looked at a perfect trade on the euro pound to recover tomorrow morning, and all your technicals told you the pound fell too low today and should recover tomorrow and go up to this point, but you didn't look to see that Mario Draghi was making a speech tomorrow morning, and he could be talking down the euro. But even though as soon as the speech is over, everything goes back to normal, you weren't aware. So there's many ways that you can look at these economic reports and this calendar to incorporate that into your trading. let me get back to our PowerPoint here. So remember, what you have to do is build the market neutral, the market negative, and the market positive. You do that by doing a little bit of research using those charts I showed you when you click on the boxes. And again, because all this data is available to you, the only thing you can't get is the actual till that event actually happened. But you can set up what I call your matrix. You can put down on a spreadsheet, if this report comes in between this price, this number, and this number, it's market neutral. It comes in this number, market positive. It comes in that number, it's going to be market negative. These are the sub-reports, and these are the bumps I'm going to give. And if all of this happens, I'm going to trade the euro to go up when that report release. I'm going to trade the euro to go down when that report, and based on market positive and market negative. And you can do all of your research. You can be prepared way ahead of time. And that's the nice thing. So on Saturday and Sunday, when you want to get involved in some of the market, you can sit there and do your research. You can open up the account. You can look and see what the report's all about. You can look and see what the analysts are saying. You can go read about it all and build your whole thing so that you are prepared to make it, to trade, or be prepared to close a trade, whatever you have in the markets, when this event is happening. So on that note, I'm going to say goodnight to everybody. I hope you learned a little bit tonight, and we'll talk to you on Thursday. Thank you very much, and have a great trading week.